Good morning, Namaskar. This is the first monetary policy statement of the new financial year 2023-24, and it is as follows. The year 2023 began on a promising note as supply conditions were improving, economic activity remained resilient, financial markets exuded greater optimism, and central banks were steering their economies towards a soft landing. In just about a few weeks during the month of March, this narrative has undergone a dramatic shift. The global economy is now witnessing a renewed phase of turbulence with fresh headwinds from the banking sector turmoil in some advanced economies. Bank failures and contagion risks have brought financial stability issues to the forefront. Given the stubbornness in inflation, central banks continue to tighten monetary policy, although at a reduced pace. Inflation globally has moderated in the recent months, but its descent to the target is proving to be long and arduous. The former chairman of the US Federal Reserve, Alan Greenspan, had once said, "Uncertainty is the defining characteristic of the monetary policy landscape." This he was saying in an era of great moderation and in more normal times compared to today's situation. What we are witnessing today is unprecedented uncertainty in geopolitics, economic activity, price pressures, and financial markets never seen before. Once again, one can imagine the magnitude of challenges central banks and other policymakers face in today's world. The Monetary Policy Committee met on 3rd, 5th, and 6th April 2023 and assessed the macroeconomic situation and its outlook. It decided unanimously to keep the policy repo rate unchanged at 6.5% in this meeting with readiness to act should the situation so warrant. Let me read this sentence again. The Monetary Policy Committee decided unanimously to keep the policy repo rate unchanged at 6.5% in this meeting of the MPC with readiness to act should the situation so warrant. Consequently, the standing deposit facility, that is SDF rate, will remain unchanged at 6.25%, and the marginal standing facility, that is the MSF rate, and the bank rate at 6.75%. The MPC also decided by a majority of 5 out of 6 members to remain focused on withdrawal of accommodation to ensure that inflation progressively aligns with the target while supporting growth. Let me emphasize that the decision to pause on the repo rate is for this meeting only. I would now like to explain the MPC's rationale for these decisions on the policy rate and the stance. While the recent high-frequency indicators suggest some improvement in global economic activity, the outlook is now tempered by additional downside risks from financial stability concerns. Headline inflation is moderating but remains well above the targets of central banks. These developments have led to heightened volatility in global financial markets as reflected in sizable two-way movements in bond yields. Fall in equity markets and the US dollar shedding its gains from its peak of September 2022. Amidst this volatility, the banking and non-banking financial service sectors in India remain healthy and financial markets have evolved in an orderly manner. Economic activity remains resilient and real GDP growth is expected to have been 7% in 22-23. Consumer price inflation, however, has increased since December 2022, driven by price pressures on cereals, milk and fruits, core inflation remains elevated. Looking ahead, headline inflation is projected to moderate in 2023-24. The monetary policy actions taken since May 2022 are still working through the system. Accordingly, the MPC decided to keep the policy rate unchanged to assess the progress made so far while closely monitoring and evolving the inflation outlook. The MPC will not hesitate to take further action as may be required in its future meetings. To recapitulate the actions taken so far, we have increased the policy repo rate cumulatively by 250 basis points in the last 11 months starting May 22. This was preceded by introduction of the standing deposit facility, that is the SDF, at a rate 40 basis points higher than the fixed rate reverse repo. Thus, the effective rate hike since April last year has been 290 basis points, 290 basis points. These increases have been fully transmitted to the overnight weighted average call money rate, that is WACR, the operating target of monetary policy, which has gone up from daily average of 3.32% in March 22 to 6.52% in March 2023. It is now necessary to evaluate the cumulative impact of these rate hikes. Under these circumstances, we have to be extremely prudent in our actions. We have always been very watchful and have adopted a calibrated and balanced approach and will continue to do so. When we started the rate cut cycle in February 2019 to provide support to growth, the CPI inflation was around 2% and the policy repo rate was 6.5%. Now the policy rate is 6.5%, but inflation is 6.4% as per the February reading. Overall, inflation is above the target, and given its current level, the present policy rate can still be regarded as accommodative. Hence, the MPC decided to remain focused on withdrawal of accommodation. What I now propose to do is to just briefly state about the growth and the inflation scenarios, and I will then try and sum up the broad approach which the monetary policy committee has taken, and I think that will give even greater clarity of what the monetary policy committee is doing. So, let me first take up growth. As stated earlier, India's real gross domestic product, that is GDP, is expected to have recorded a growth of 7% in 2022-23. Hence, economic activity remains resilient. On the supply side, Rabi food grains production is estimated to increase by 6.2% in 2022-23. PMI manufacturing remained robust at 56.4 in March, recording expansion for 21 consecutive months due to favorable domestic demand. Service sector activity exhibited buoyancy. PMI services remained in expansion zone at 57.8 in March, driven by favorable demand conditions and new business gains. Aggregate demand conditions were resilient in Q4 of 22-23, even as private consumption showed some signs of slowdown. Urban demand indicators like passenger vehicle sales and credit card spending registered robust growth in February, while consumer durables contracted in January. Rural demand indicators such as consumer non-durables, tractor and two-wheeler sales registered healthy growth. Investment activity exhibited buoyancy on the back of government's thrust on infrastructure spending, high capacity utilization, and revival in corporate investment in certain key sectors. Non-food bank credit rose by 15.4% year-on-year as on March 24th, 2023. The total flow of resources to the commercial sector has increased by 26 lakh crore during 2022-23 as against 19 lakh crore a year ago. Merchandise exports and non-oil, non-gold imports contracted in February. Services exports continued to register robust growth. Supply chains are returning to normalcy globally as well as domestically. Looking ahead, the higher Rabi production has brightened the prospects for agriculture sector and rural demand. The steady growth in contact-intensive services should be positive for urban demand. The government's focus on capital expenditure, capacity utilization above long period average and moderating commodity prices should bolster manufacturing and investment activity. The drag from the net external demand may continue due to increased global headwinds. The protracted geopolitical tensions and global financial market volatility pose downside risks to the outlook. Taking all these factors into consideration, the real GDP growth for 2023-24 is projected at 6.5%, with Q1 at 7.8%, Q2 at 6.2%, Q3 at 6.1%, and Q4 at 5.9%. The risks are evenly balanced. Let me now turn to inflation. The softening in inflation during November-December 2022 turned out transitory, with CPI headline inflation breaching the upper tolerance threshold during January-February 23. A sharp turnaround in food inflation drove the pickup in headline inflation as core inflation remained elevated across a range of goods and services. Looking ahead, the expectation of a record Rabi harvest bodes well for easing of food price pressures. There are already evidence of a correction in wheat prices in March on supply side interventions by the government. The impact of the recent unseasonal rains in some parts of the country, however, needs to be watched. Global commodity prices have moderated significantly from their heightened levels a year ago. As our surveys point out, cost conditions have somewhat eased. Inflation expectations of households have also eased down. On the upside, adverse climatic conditions are a risk to the future inflation trajectory. Milk prices are also likely to remain firm going into the summer season due to tight demand-supply balance and fodder cost pressures. The rising uncertainty in international financial markets and imported inflation pressures need to be monitored. Factors, and assuming an annual average crude price Indian basket of 80 barrels and a normal monsoon, inflation is projected to moderate to 5.2% for 23-24, with Q1 at 5.1%, Q2 at 5.4%, Q3 5.4%, and Q4 at 5.2%. The risks are evenly balanced. Now, let me now summarize what I have said so far. We are living in very volatile times. The sudden announcement of an output cut by the OPEC Plus a few days ago and the resultant jump in crude oil prices is yet another evidence of this volatility. The overall outlook thus remains dynamic and fast evolving. Our monetary policy in the recent period has aimed for a non-disruptive normalization from the pandemic era stimulus measures. Even as monetary policy moved decisively to withdrawal of accommodation financial conditions evolved in line with the productive requirements of the economy. Growth has since then become broad-based. Inflation has softened from its elevated levels a year ago. However, it still remains above the upper tolerance band. Projections for 2023-24 point to a softening in inflation, though the disinflation is likely to be gradual and protracted given the rigidity of core or underlying inflation pressures. At this stage, we remain watchful of the evolving outlook and the impact of our actions during the past 1 year on the broader real economy. While we have kept the policy rate unchanged, it is important to bear in mind that this decision was taken on the basis of our assessment of the macroeconomic and financial conditions with reference to the information available up to today. Our job is not yet finished and the war against inflation has to continue. And this has to continue until we see a durable decline in inflation closer to the target. Let me read again. Our job is not yet finished and the war against inflation has to continue until we see a durable decline in inflation closer to the target. We stand ready to act appropriately and in time. We are confident that we are on the right track to bring down inflation to the target rate over the medium term. As we proceed towards this objective, I recall the wise counsel of Kautilya 2000 years ago, and he said, and his statement was as follows: be not slack before the job is finished. Be not slack before the whole job is finished. I would now like to focus on financial stability. With the fight against inflation far from over, the global economy is now confronted with serious financial stability challenges from the recent banking sector developments in certain advanced economies. This calls for a reappraisal of the responsibilities of the regulators and the regulated entities world over and their collective role in safeguarding the stability of the financial system. While regulators need to identify potential vulnerabilities and take proactive regulatory and supervisory measures, it is important and incumbent upon the regulated institutions to exercise due diligence in their risk management and corporate governance practices. They need to pay close attention to asset liability mismatches and profile of their deposit base while building up adequate capital buffers and conducting periodic stress tests. It is in this context that we in the Reserve Bank of India have focused on macro and micro prudential measures in the recent years to prevent buildup of financial vulnerabilities. We have adopted a prudent approach towards regulation and supervision and have taken several steps in these areas in recent years. Some of these regulatory measures are listed in the footnote of this statement. Our supervisory systems have also been strengthened significantly in recent years. We have adopted a unified and harmonized supervisory approach for commercial banks, non-banking financial companies, that is NBFCs, and urban cooperative banks, that is UCBs. The focus is now more on identifying the root cause of vulnerabilities rather than dealing with the symptoms alone. As a result, the Indian banking system remains sound and healthy with strong capital and liquidity buffers, improving asset quality, better provisioning coverage along with improved profitability. Nevertheless, we are keeping a close watch on the banking sector turmoil in some developed countries. In this context, let me once again recall Kautilya's wisdom. which remains relevant even for today's world. And I quote, "In the interests of the prosperity of the country, we should be diligent in foreseeing the possibility of calamities, try to avert them before they arise, overcome those which happen, remove all obstructions to economic activity." I would now like to touch upon liquidity and financial market conditions. The Reserve Bank will continue to adopt a nuanced and agile approach to liquidity management. Amidst large moderation in surplus liquidity, the Reserve Bank conducted 14-day variable rate repo auctions, which is the main operation on February 10th and March 10th, and also a fine-tuning 5-day variable rate repo auction on March 24th. In the period ahead, the Reserve Bank will remain flexible in meeting the productive requirements of the economy through two-way operations as may be necessary. We will also ensure the completion of the government borrowing program in a non-disruptive manner while maintaining orderly market conditions during 2023-24. The Indian rupee has moved in an orderly manner in the calendar year 2022 and continues to be so in the current year, that is 2023 also. This is reflective of the strength of the domestic macroeconomic fundamentals and the resilience of the Indian economy to global spillovers. We remain watchful and focused on maintaining the stability of the Indian rupee. Let me now turn to the external sector. The current account deficit for the first 3 quarters of 2022-23 stood at 2.7% of the GDP. In third quarter, current account deficit narrowed significantly to 2.2% from 3.7% in the second quarter on account of lower merchandise trade deficit and robust growth in services exports. Strong software services export growth was witnessed across key verticals such as IT services, business process management, and engineering and research design, supported by a rise in global capability centers. The merchandise trade deficit further narrowed during January and February 2023 from its level in the third quarter of 22-23 on the back of a sustained decline in imports. Moreover, India's services exports continued to grow at a healthy pace in the first 2 months of the current calendar year, that is 2023. Better growth prospects of the Gulf Cooperation Council, that is the GCC countries, are expected to keep remittances robust. In fact, inward gross remittances into India touched an all-time high of $107.5 billion during the calendar year 22. The current account deficit is expected to remain moderate in the fourth quarter of 22-23 and also in the year 23-24 at a level that is both viable and eminently manageable. Overall, our external sector indicators have improved significantly. Foreign exchange reserves have rebounded from $524.5 billion on 21st October 2022 and now stand in excess of $600 billion, taking into account our forward assets. I shall now announce certain additional measures. There are 5 of them and they are very important. I request your patience. The first announcement relates to developing an onshore non-deliverable derivative market. Banks in India with IFSC banking units, that is IBUs, were earlier permitted to transact in Indian rupee non-deliverable foreign exchange derivative contracts with non-residents and with other eligible banks having IBUs. It is now proposed to permit banks with IBUs to offer non-deliverable foreign exchange derivative contracts involving the Indian rupee to resident users in the onshore market. This measure will further deepen the forex market in India and provide enhanced flexibility to residents in meeting their hedging requirements. The second announcement relates to enhancing efficiency of our regulatory processes. At present, the processes for entities to make applications seeking license or authorization or regulatory approvals from the Reserve Bank under various statutes and regulations take place in both online and offline modes. To simplify and streamline such processes and in line with the Union Budget 23-24 announcement, it has been decided to have a secured web-based centralized portal named as Prabha for such processes. The portal will show time limits for deciding on the applications or approvals sought. This measure will bring greater efficiencies into regulatory processes and facilitate ease of doing business for the regulated entities of the Reserve Bank. The third announcement relates to development of centralized web portal for the public to search unclaimed deposits. At present, the depositors or beneficiaries of unclaimed bank deposits of 10 years or more have to go through the websites of multiple banks to locate such deposits. Now, in order to improve and widen the access of depositors or beneficiaries to information on such unclaimed deposits, it has been decided to develop a web portal to enable search across multiple banks for possible unclaimed deposits. This will help depositors and beneficiaries in getting back their unclaimed deposits. The next announcement relates to grievance redress mechanism relating to credit information reporting by credit institutions and credit information provided by credit information companies, that is the CICs. Recently, the credit information companies, that is CICs, were brought under the purview of the Reserve Bank Integrated Ombudsman Scheme. It is now proposed to put in place the following measures. 1. A compensation mechanism for delayed updation, rectification of credit information reports. 2. A provision for SMS, email alerts to the customers whenever their credit information reports are accessed. 3. A time frame for inclusion of data received by the CICs from credit institutions. And 4. Disclosures on customer complaints received by the CICs. These measures will further enhance consumer protection. The last announcement relates to, and this is very important, if you recall, almost in every monetary policy meeting and even otherwise, the Reserve Bank, we have been making lot of announcements relating to the UPI. And this announcement also relates to UPI. Basically, the objective is to widen and expand the footprint of the UPI even further. And this announcement relates to operation of pre-sanctioned credit lines at banks through the UPI. The Unified Payment Interface, that is UPI, has transformed retail payments in India. UPI's robustness has been leveraged to develop new products and features from time to time. Recently, RuPay credit cards were permitted to be linked to the UPI. This was in addition to the existing facility of linkage of UPI with deposit accounts. It is now proposed to expand the scope of UPI by permitting operation of pre-sanctioned credit lines at banks through the UPI. This initiative will further encourage innovation. Let me now conclude by stating that since early 2020, the world is going through a period of extreme uncertainty. In this daunting environment, India's financial sector remains resilient and stable. Overall, the broadening of economic activity, the expected moderation in inflation, the fiscal consolidation with focus on capital spending, the significant narrowing of the current account deficit to more sustainable levels, and the comfortable level of foreign exchange reserves are welcome developments which will further bolster India's macroeconomic stability. This allows monetary policy to remain unwaveringly focused on inflation. With underlying core inflation, or rather with unyielding core inflation, we remain firm and resolute in our pursuit of price stability, which is the best guarantee for sustainable growth. Let me read again. With unyielding core inflation, we remain firm and resolute in our pursuit of price stability, which is the best guarantee for sustainable growth. The impact of our actions over the past 12 months is still playing out and would increasingly weigh on the future inflation trajectory. As I noted in my policy statement in April last year, our goals of price stability, sustained growth, and financial stability are mutually reinforcing, and we continue to be guided by this approach. We remain vigilant and ready to face the challenges with a firm commitment to price and financial stability. We are inspired by what Mahatma Gandhi had said, and I quote, "Inexhaustible perseverance and patience